According to the British Retail Consortium, December saw a year-on-year 3.5% decrease in footfall, that is the number of people pounding high streets and malls looking for things to buy. The figure is the steepest decline in nearly 5 years, and general retailers suffered most. Sales in stores fell in the last quarter of 2017 when compared with the same period the year before, but online sales rose 6.2%. Debenhams and Mothercare fared even worse. Both said profits would be lower than expected. The share price of all three retailers is now lower than it was 5 years ago, and Mothercare has been hit particularly hard, slumping from a high of 388.5p in 2013 to 47.25p at the end of last week. These retailers have been around for decades, if not centuries, and M&S was once the blue blood of the sector. Then there are retailers which combine a decent high street presence with a lively online business. At Giles Group, Christmas sales rose by more than 19% on a year ago, and the company sold more full-price stock than in 2016. Known for its colorful clothing, Giles does not call itself a fashion retailer, but a lifestyle brand appealing to young at heart, middle-class women. The group aims for a seamless approach to sales, delivering goods via its own stores, concessions and at home both here and abroad. However, while the NM has gone from strength to strength, Card Factory has struggled, and the shares are now at 202.5p. That is below their flotation price and 44% lower than the 360.75p they were at when Midas recommended them in November 2015. The share price was savaged after a disappointing trading update this month. Christmas sales rose year-on-year, but the group admitted profits for the year to January 2018 would be lower than city expectations, as customers gravitated towards lower margin items. A dividend of 20p is penciled in for the year, putting the stock on a yield of about 10%. They also want some entertainment. Shopping is supposed to be fun, whether online or in store. Those retailers that have grasped that are increasing sales and stealing market share. Woohoo, the only ones crying are investors who failed to buy Mohamed Kamani and Carol Kane have formed. Throughout much of the 1990s, the duo worked together to supply high street retailers with the latest fashion items for customers. Having built an understanding of the market and an enviable distribution network, they founded their own retail business, Woohoo, some 10 years ago. The business has grown in leaps and bounds since then. In the 12 months to February 2017, Kamani and Kane delivered sales of £295 million and profit of almost £25 million. This year, turnover of more than £550 million is expected, alongside profits of about £45 million. Unlike ASOS, its much larger online rival, Boohoo only sells its own brands. Initially, there was just the eponymous Boohoo brand. Then two more were acquired, Pretty Little Thing and Nasty Gal. All three appeal to the youth market, but each has a slightly different nuance, and each has its own website. sales are processed from a 1 million square foot, 5-story warehouse in Burnley, Lancashire. This warehouse is due to double in size and overseas centers are likely to open in time. Other brands may join the Boohoo stable, but expansion is likely to be measured. MIDAS verdict: Boohoo is valued at more than £2 billion, but Kamani and Kane are keen to expand the company further, turning it into a worldwide fashion phenomenon. Progress has been encouraging to date, but there is plenty more to come. $187.25p. The shares have done well since the flotation, but they are off their summer peak, following short-term concerns over profit margins. These should be ironed out over time. BUY